Time to see what's on the radar for Philip Petursson, Chief Investment Strategist at IG Wealth Management. And a few sectors to talk about. First up, though, energy. And lots to like about it right now. I was just looking for the energy index on the TSX up nearly 19% for the year.
Exactly, year to date. So we're not even out of February just yet. And yet we've seen significant gains out of the energy sector, not only the producers themselves, but energy services companies. And the reason why we believe we've been bullish on energy since tail end of last year. And if we went back to that point, everyone's talking about oil glut, oil's dead.
They were saying a million plus barrels a day.
Exactly. And while that's true, we do see excess supply right now, but look at where we're going, right? And we often say the cure for low prices of oil is low prices of oil, meaning producers stop investing in new wells, and gradually that production starts to roll over. And that's what we're starting to see in the United States, going from about 13.5 million barrels a day, rig counts dropping. We could see oil production in the US drop off 1 million, 2 million barrels before the end of the year. And that is what's being, I think, priced into the oil producers and the price of oil at 67. So part of it is geopolitical risk, what's going to happen in Iran. But part of it is, hey, we know that this glut isn't going to be long lasting because there's no new production coming online. And that's starting to push up, the producers as well as the services companies.
But is OPEC Plus not talking about at their March meeting that they're going to ease up?
They in terms of increasing production, if they have production to actually increase, and that's the question is we believe that the only country that has any spare capacity might be Saudi Arabia, but they're at the upper end of that. They don't have much spare capacity to go, so they can say we're going to increase production, but where is it actually going to come from? And that's the big question. It's more talk than action.
And so where does that leave Canada, the oil companies here, leaves them in a good spot?
Right, it leaves the energy sector in a very, very positive spot, leaves the TSX in a very positive spot. Globally, if you want to play oil, one of the safer ways to do it is to buy the TSX. Our index is highly correlated to the price of oil, and if you look at the correlation between the other sectors and oil, still very strong. And I think that's obviously one of the reasons why we've seen the TSX outperform this year, and our expectation why it's going to continue through the remainder of 2026.
What about Venezuela for that? How much of a factor is if we start losing the oil going south to Texas and
this is a big question. Well, will we actually lose it? No, we won't, right? If you look at the pipelines coming from the oil sands into the United States, going to a different location than where Venezuelan or heavy oil is coming in from the Gulf. So we're not going to see one displace the other. And even still, listen to what the energy executives are saying in the United States when they had that round table, and Trump said, "Here we go. Here's Venezuela. It's open for you." And they're saying it's too expensive. The infrastructure is too antiquated. We're not going to invest that at this point. With these prices, it just doesn't make sense. So Venezuela wasn't so much opening of the tap for U.S. oil producers as it was choking off supply to China. And in our view, and we saw the reaction, from the drop in oil prices with the capture of Maduro to the very, very quick recovery and the gains. So it doesn't really have anything to do with Canadian oil.
All right, I want to jump metals next. I mean, while silver, it's in its own little spot there on what it's doing, depending on the day, depending on the moment. But gold, what are you seeing? What are you liking about them?
Right. So we've been bullish on gold for a while now. That's a couple of years now. And the way we measure gold is relative to the money supply. And that's a better measure of inflation as opposed to CPI. And we've seen gold re-rate higher to M2 and continues to move higher. Now, from our fair value range, it's at the upper end. But what do we know, right? We know that the U.S. is running at close to a 7% deficit. We know that they're going to roll over a lot of their debt, and this debt is becoming more expensive. So that actually, and we're seeing, kind of a soft de-dollarization going on around the world. That's good for gold. As the U.S. dollar weakens, gold prices move up. As money supply increases, gold prices move up. So, we could see gold move up, not to the extent that we had last year in the 65% range, but could we see it, 10 to 15%? Sure, I think we could from here. And so we still like gold, still own gold. The gold producers are even in a better position because they're leveraged to the change in the price of gold. That's why they, for every, for example, 1% that we're seeing the price of gold move up, they're moving up 2 to 3.
All right. And we got about 30 seconds. Sorry, for software. We're almost out of time because we got to hit a time here. But software, where do you see that going?
Yeah, we've seen it taken down quite significantly over the past couple of weeks on this AI fear, but we think it's overdone at this point or close to it. Not every software company is going to be mothballed because of AI, especially the cybersecurity companies. I can't see any CIO or CTO going to their board saying, yes, we're going to let AI run our cybersecurity now instead of CrowdStrike or whatever the company is. It just makes no sense.